In this video, we're going to look at the best performing cryptocurrencies in the market right now. I'm going to look at the fees and revenue that they're generating, the growth of users, and why they would be good investments versus Bitcoin and Ethereum. So I'm going to try and convince you and myself of that, why you would actually put money in these things versus just going Bitcoin and ETH. Because let's look at Ethereum right now. This thing is extremely positive from a charting perspective. We had the huge drawdown during the bear market, as you can see. But since then, since the potential bottom at $1,000 back here, almost a year ago, we've just seen a slow and steady grind of higher lows. You can see that happening here. This is very positive price action. Why should you take money out of DCAing into Bitcoin and ETH and put them into altcoins? Let's look at the data in this video. I'll leave timestamps for everything below. Let's look at Ethereum firstly as a benchmark as to what we're investing in here. You can see Ethereum is the most profitable protocol in crypto by multiples. Tron obviously very profitable as well. A very different type of network to invest in though. Much more specific risk there. If we look at Ethereum, you can see that the revenue generated for Ethereum holders is around 371 million per month at the moment. Anyway, the revenue annualized is about 4.5 billion in a bear market. So bull market, that's going to be potentially multiples of what it is now. A profitable protocol that pays yield to the people that stake it. This is Lido right here. So the most popular staking protocol on ETH. And really only just to show you that if you stake ETH as an investor, you're getting a 4.69% APR on staking rewards. Plus also what we're getting from Ethereum as well is a deflationary token of, at the moment, around 0.5% per year. So you're looking at a total yield of around 5% real yield in Ethereum. So all of these other protocols, to be a better investment, have to beat that by quite a way because they're obviously much more risky than Ethereum, given the specific risk of a smaller protocol, mostly built on top of Ethereum, and the competition that exists throughout all of these protocols where Ethereum is extremely dominant. So let's look at all of the potentials to invest in. If you want to learn more about what I'm actually talking about in this video, check out the Crypto Investor course linked down below. It has 300 plus videos on cryptocurrency and then actually investing, trading, and putting a portfolio together. You can see all these videos here, private Discord community as well, where you can come and ask me questions, see my trades, see my portfolio. If that's interesting for you, link down below. Let's come to Ethereum layer 2s. Do these offer a better investment opportunity versus ETH? Because in the last bull run, a lot of alt L1s sprung up as ETH became congested and a lot of people wanted to bridge assets over to those alt L1s to use basically Ethereum just way cheaper on those different chains. Those chains forked Ethereum basically and just made it cheaper. So that happened in the previous bull market and a lot of money was made from those tokens if you got out at the top. However, in the next bull run, I believe that most of the activity is going to be on ETH layer 2s directly. It's a better usage experience from a user's point of view to just bridge tokens up to a layer 2 rather than to take them to a different chain. That's my opinion anyway. This data is proving this during the bear market. You can see this usage data for ETH L2s absolutely blowing up, right? Mostly Arbitrum. You can see the amount of gas used is going to all-time highs, essentially. Arbitrum also doing as many transactions per day as the ETH base layer. I believe that most users that want to use Ethereum and want to use Ethereum on a cheaper chain will probably just bridge over to those L2s rather than take their money out to a separate L1. That data is being proven here. So are these a good investment and are these going to go just like the alt L1s in the previous cycle? Let's have a look at that. So firstly, I want to differentiate between a layer 1 gas coin, which I believe is more of like an asset or a store of value, versus a layer 2, which I believe has to be valued just like a business. Because L2 tokens, especially Arbitrum and Optimism, they earn their fees in ETH. And so they are a business that provides a service that earns their own profits in Ethereum as the layer 1. So you can only value a DAO token for example, Arbitrum's DAO token, based on how much ETH that you think they should earn. And then you put a multiple on the amount that you think they're going to earn. And then that brings out a valuation, either over or undervalued in an investor's opinion. But these L2 tokens, for me, are essentially going to be using equity valuation models And that's different than a currency type valuation model, which I think Bitcoin and Bitcoin specifically, and then L1 tokens can use as well for the most part. So if we look at this, you can see that Arbitrum, they actually use the excess revenue that they make from fees and they put it into the Arbitrum DAO. Now, the feed through is, well, you would expect that a DAO is eventually going to vote to return that money to themselves. So that is essentially just like a dividend or whatever, that gets sent out to investors. So we can think of the excess revenue here as profits, and you would have to put just a valuation, a multiple on that, maybe 20 times what they earn, 50 times what they earn. So let's look at Arbitrum right here. It's one of the most profitable protocols here. You can see revenue. Fees are about 10 million, but the revenue is about $1 million. So you actually want to look at revenue because that is the thing that is accruing to the DAO. So $1 million in revenue over the last 30 days, annualized, you're looking at about 11 million in revenue. Based on the current amount of revenue that Token Terminal anyway says actually accrues to the protocol, you can see here revenue, which is the share of transaction fees that go to the network fee accounts. So I'm assuming this is the amount of excess revenue that actually gets accrued to the DAO. You're looking at a price to sales of 1,000 times, which is obviously insane. So the revenue has to really ratchet up a lot if it is to justify the current valuation. Unfortunately for Arbitrum, what you've got here is a market cap fully diluted of 11 billion, which is actually more expensive than MATIC. The reason is you just have the vast majority of Arbitrum tokens that have yet to be unlocked. It's not a disaster. What can actually happen is that the fully diluted market cap actually goes nowhere for a long period of time. But what happens is you send the tokens out and you release those tokens and you just get this churn in the market where people are valuing the DAO based on how much ETH it has in there and saying, I'm willing to pay X amount for the token. And so the fully diluted stays the same, but the market cap in the market, and as you can see here, because the vast majority of Arbitrum tokens haven't been released yet, the market cap is 1.4 billion, fully diluted 10x that essentially. So what you get potentially is the market cap actually moving up or staying the same, and the fully diluted, it's basically eating into the fully diluted valuation at that point, which is a potential. However, with the current revenue run rate, something really needs to change because obviously this is not a mature business. It's growing extremely well, but it's not cheap, essentially. It's not a cheap investment at 1 billion and 11 billion fully diluted. It's not a huge bargain based on current run rate, but revenues could go up 3, 5, 7 times if you get a really stonking bull market, which definitely changes the current valuations for sure. The next most popular layer 2 is MATIC. MATIC's a totally different beast because it has the proof of stake chain, and it's also just launched the ZK EVM, which is a real layer 2 on top of Ethereum. From what I've read about Polygon and what their plans are, they are trying to move as much as they can off of the proof of stake chain and making it easy for developers to just port all of their stuff over to the ZK EVM. ZK EVM is a real layer 2, and that's kind of, what people are going to want to use versus the proof of stake chain, which is much more centralized. That's happening right now. Polygon has $1 billion of value locked on the proof of stake chain. On the ZK EVM, only 16 million, but you can see this is going up. So people are slowly moving over to the ZK EVM chain. And I presume that this is going to be actually the main chain going forward, taking away from the proof of stake chain. Polygon is a little bit different to layer 2s in how it's valued because MATIC is also a layer 1 with its proof of stake chain, and it actually implements a buy and burn mechanism exactly the same as Ethereum. So fees actually get automatically put towards buying back Polygon, which is obviously a buyer in the market that supports the price. They also pay a staking yield. And Polygon, most of the supply is now out in the market. You can see the fully diluted market cap for Polygon is 8.9 billion. It's actually cheaper than Arbitrum, despite basically being the number one kind of L2 from Ethereum. So most of the activity is on Polygon proof of stake and moving to ZK EVM. It's actually fully diluted, cheaper than Arbitrum. Its revenue 30 days is 2.4, revenue is 30 million. And as you can see, price to sales is around 300. So from a valuation perspective, much cheaper than Ethereum, despite it having a higher market cap in the market. because all of its tokens more or less are basically out in the market already. Why is MATIC valued so highly despite making only 30 million in revenue? If we go back to other coins, there are many others that actually make way more than this, but are undervalued in comparison to MATIC. For example, Uniswap makes, around 60 million in fees, no revenue to the token, but if they switched on a fee switch and took 10% of fees, you'd be looking at 60 million a year, maybe run rate. Why is MATIC valued much higher than that? It's because MATIC has an L1, and so it's valued more on a network valuation model versus Uniswap, which really would be valued on price to earnings basis because it's a protocol and not a network. So that's where these L1 coins have slight network valuation models versus price to earnings models, which can muddy all of the valuations that you're trying to put on these assets, because you have to make that determination first and how much it makes up of the valuation of the token before actually coming up with some valuation that you think might be appropriate. Let's look at DeFi tokens and how much they're earning, because some of these DeFi tokens are making millions and millions of dollars per month. And so that can actually come to a DAO and generate revenue and income for investors. So the most popular protocols right here, Uniswap currently takes no revenue, right? So liquidity providers take all of the revenue. However, the fee switch is being teased and teased. So they obviously do want to turn that fee switch on where they may get, let's say 5 or 10% of revenue the LPs earn, right? Liquidity providers earn. Currently, you can see that the protocol is earning around fees annualized around 700 million right here. The revenue to the token is 0 because they don't have a fee switch. So as you can see, the price to fees ratio is 7. If you were to take 10% of annualized fees, that would obviously be a 70% price to revenue multiple, right? So if they were taking 70 million a year, the current fully diluted market cap is around 5 billion. So the revenue multiple would be 70 times. 70 times is a very high multiple. Now, Uniswap, again, in a bull market, the revenue could literally explode by 5 times more than this, making this token potentially right now seem very rich, but not potentially in a bull market when trading volumes really pick up. And we're seeing very high trading volumes on Uniswap. It's definitely being more used over time. It's very, very popular as a protocol. So again, potentially this is a decent play, but then you have regulation coming in that might affect Uniswap and a lot of other specific risk. And also it actually doesn't accrue any revenue right now. You have to assume that fee switch is going to be coming on. We'll look at charts later on how all of these DeFi tokens are faring in ETH terms, because if you're buying one of these tokens, you need it to outperform ETH, not just outperform the dollar. So this again looks expensive now, but in a bull market could be decent in terms of a valuation for a business that makes revenue. Let's look at Aave as well. Again, not trading very cheap. It's actually 88 times price to sales, so it earns 12 million annualized. Not a huge business here, but during a bull market, maybe that goes up 5x in terms of the revenue, which would bring down the price of sales to a pretty decent level, to be honest. So you're having to pay a high valuation, even in a bear market. And the over-collateralized lending model is not a scalable market, which is why they're going into different things like stable coins, which they would try to make money off that stable coin. So again, not a cheap valuation here, but could be okay in a bull market. But again, we'll look at it versus ETH because it has to outperform ETH. We also have GMX, which is one of the most popular protocols on Ethereum. It's actually built on Arbitrum, and so it's the main derivatives protocol there. Derivatives is potentially quite scalable as a business, although GMX has some downsides with it, the way that it's set up. And derivatives protocols really, they just have to make sure that they don't get blown up, because if people are taking leverage and some of those liquidations don't matter or don't occur properly, then the protocol is on the line for the difference. So that's always a potential downside for derivatives protocols. Price to sales is 27 times. It's actually not bad. It's the cheapest valuation here. There is some downside to the GMX token though. Really, you can see the GMX token might be valued on a yield basis, currently paying around 2.7%. So again, compared to ETH that's yielding 5%, why would you get GMX considering the specific risk of GMX versus Ethereum? Glassnode recently released this report as well, showing ETH performance versus DeFi specifically. Huge underperformance from DeFi. Minus 45 for ETH from its all-time high. DeFi significantly worse than that. You have ETH now, after all of the upgrades, that funnels basically all of the profits back into the token, supporting that valuation. DeFi doesn't do that yet. So you've just got a bear market with, difficult to raise funds for these protocols. Are they even selling their own token to fund development? It's a possibility. That's what you get. You get profit taking and difficult businesses for these protocols, but ETH is just sitting there taking fees in all day long as a decentralized protocol. And so cream rises to the top eventually, and that seems to be what's happening here. But another bull market could potentially put some more speculation into DeFi, but without that, it's just going to keep dripping away, in my opinion. The charts never lie as well, so let's have a look at the top DeFi protocols versus ETH. This is Uniswap versus ETH. Uniswap, potentially a very profitable business. It hasn't gone anywhere versus ETH. So again, why invest in it versus ETH? Then we've got Maker, which is just down only. An absolutely torrid chart right there. Really, really poor. Now you've got Lido here, which has probably just stood its ground. That makes sense because Lido just does staked ETH, right? So Lido's whole business model is it just takes 10% of whatever's staked with it. And so it's basically just ETH, right? So, it's got ETH in the DAO there. So it makes kind of sense that it would tread water against Ethereum. And then this is Aave, just another torrid chart, right? So literally all-time low in ETH terms. Why invest in these when you can invest in ETH itself? Let's look at layer ones though, because even in the bear market, this data is showing that layer ones are growing. And so at least we can see more users are coming here, even though all of the altcoin tokens are having a bad time of it during a bear market. The tokens aren't doing well. However, L1 is showing growth. So BNB Chain, Polygon, Ethereum, and Tron really standing out as the most unique addresses. However, unique addresses isn't real people. People can have 10 accounts with addresses. You might get bots or other, parts of the system that create wallets for some reason. So this isn't people, but growth is growth. And we can try and compare it across chains. There is a lot of growth here, but as you can see, there is most growth on BNB and then the Ethereum set. So Polygon, Ethereum, Arbitrum, Optimism having big growth here in double digits. And then Avalanche, a crazy amount. That may be a launch of a subnet or whatever they call them right there. So a big amount of growth. But obviously it's the amount of users and how much they transact in that L1 growth model, in the network adoption model, which has the valuation. So the amount of users and how much they transact in dollar terms gives the valuation. Bitcoin is number one in that. It's actually got fewer users than some other chains, but much higher value per transaction. And Ethereum is very high on that regard as well. BNB, much lower transactions in dollar terms, but a lot of users. And so those valuations come about and they're pretty good in terms of a valuation model. So what we can see here, I just want to compare ETH versus the other L1s. This is Tron, which has done pretty good in dollar terms, but in ETH terms, underperforming, and it just looks like a very continual downtrend there. Maybe starting to find an equilibrium price here, but in ETH terms, it has underperformed. Then we come to MATIC token, actually done pretty decently. MATIC is a lot newer than Ethereum, and it's not just an L1, you've got other things as well, but kind of held its own, not really gone anywhere, kind of treading water against ETH, in ETH terms, but coming down, a huge underperformance recently during the bear market. Potential of a reversal here, but still kind of treading water. We then have ADA versus ETH actually at a massive support point right here. So you can see that each time we've come into this support level down here, we're doing that again right now. But again, a very tough bear market. So ETH really just standing out in the bear market of actually being profitable and actually paying real yield rather than most of the other tokens which don't. Although Tron and BNB do, Cardano still has some token inflation and just a much smaller market, and so it suffered a little bit more. Let's go over to Solana as well. An outperformer in the bull market, but as we can see here, Solana versus ETH down only again. So it's very, very difficult to choose something to actually put your money in versus ETH. It's just data. If there was something better in the data, then obviously, you would go into it. Out of all of the big coins, the only one to outperform ETH over the last few years is amazingly BNB coin. You can see this outperformance. However, maybe we're just starting to get into a kind of a full valuation for BNB, and it's starting, you know, you can just see this kind of rounded top, right? So yes, it's done well, but it's struggling to kind of really move upwards and forwards in ETH terms as well. So maybe it won't underperform, maybe it'll just tread water versus ETH, but when you're investing in other L1s, you've got to look for something that's going to outperform ETH, otherwise you just go into that. And so this one has, but obviously in the future, there's questions whether it can really grow as big because of the nature of BNB being slightly more centralized, at least the optics of it being slightly more centralized versus ETH, which, you know, seems to be moving more and more and more towards being an infrastructure. And there's a lot more going on top of ETH in terms of Coinbase building on top of it and all of the other networks that are going. So the scaling's really taking place. So that's maybe a reason why seeing BNB, even though the outperformance here is slightly just maturing in the way that its price is performing in ETH terms. And the chart we all want to see, which is Bitcoin versus Ethereum, it's a very interesting chart. Both Bitcoin and ETH are hugely successful networks. You have, like I said, the amount of users times the amount that they transact in dollar terms gives you the network valuation model. Both are successful, but very different. Bitcoin with proof of work mining is completely unique in what it does and the size and scale of that network, and it's just growing exponentially. ETH is also doing it in a different way and maybe a different part of the market. But as you can see here, ETH valuation is just grinding and grinding higher versus Bitcoin. Over the last 2 years, you can see that happening where the ratio between Bitcoin and ETH is grinding higher. We are meeting significant resistance at this ratio between them, which is around 0.085 in terms of the ratio between Bitcoin and ETH. And it's right here. This is an ascending triangle, typically a bullish pattern where, you know, each low is just bought up. And then a chartist would expect this to actually break to the upside and you get price discovery. I don't know if that's going to happen. And I'm not a fan of ETH versus BTC or anything else. I just want to see the data. What is the best performing asset? Because as an investor, that's what you want to go into, or maybe have a diversified portfolio in some assets that are all doing quite well, because you can't predict what's going to happen in the future. But here is the data. A lot of performance for ETH versus everything else. Still not breaking out versus Bitcoin though, but it could potentially. Check this chart on TradingView, Bitcoin and ETH, because it's very important, and this is going to break out one way or another, either up or down, and that may be due to macro rather than what's happening in crypto, but very interesting chart. I don't care about any of these protocols. I don't support any L1 like a football team. I just want to invest in the thing that's going to perform the best over the next decade. And maybe not just one, but 2 or 3 of them is also good enough. If you want to talk to me about that, link in the description, the private Discord groups, I'm in them as part of the Crypto Investor course. You can check all of that out. Exchange bonuses linked down in the description as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.